Hi, welcome back. In this video, we're going to look at the different types of stock that you can purchase, the different categories that are available, and we'll talk a little bit about what is the strategy that people use to build a collection of stocks called a portfolio that helps protect them from risk and yet still enable them to make money over time. So we start first by looking at different types of stock based on your ownership. When it comes to that, we have two options. One is called preferred stock, and preferred stock generally guarantees that if a company is paying dividends, you get paid dividends first. But it does mean also that you're sort of giving up the guaranteed right to vote as a stockholder. Whereas with common stock, you may not get a dividend, might if they offer it, might not, but you have a greater say in how the company is run than those who have preferred stock. So it's sort of a trade-off between guaranteed dividends and having a say in how the company is run. We can also categorize stock based on the level of risk associated with the company. When we talk about blue chip stocks, we're talking about stocks typically traded on the New York Stock Exchange or that are part of the Dow Jones Industrial Average, which we talked about in a previous video. Those are companies that are solid, reliable. They've been around a long time. They're very large. They have a history of growth and stability. They don't have wild swings of profit and loss. They're just constantly, steadily making money over time. And they usually have a reliable dividend payment. And so these companies represent very low risk, but also very low return. But people are willing to not get a huge return on their stock in order to be safe. And so they will buy these types of stocks often. Examples would include companies like General Electric or Walt Disney, Walmart, these sort of large, big, successful companies over time. You could also choose what are called defensive stocks. These are companies that tend to be stable throughout a business cycle. That is, when the economy is growing, they tend to grow at a reasonable pace. When the economy is shrinking, they still tend to grow at a reasonable pace. They are very safe and less risky than others because they're generally offering products people need no matter what. And so when there's a recession, when the economy shrinks, these companies still tend to do well because people just need their product. For example, Procter & Gamble makes consumer products like soap and shampoo and toothpaste. These are things people need no matter how bad or good the economy is. People still need medicine no matter how good or bad the economy is. And that's why pharmaceutical companies like Johnson & Johnson or Pfizer are successful. People still drive cars and own property. They still need insurance. No matter what the economy's health, and so companies like State Farm tend to do well. These companies will generally shield you from negative economic activity and enable your portfolio to continue to be successful over time. So there's one word that describes a healthy portfolio or a healthy collection of stocks. It's a very important word, and that word is called diversified. When we say things have a certain degree of diversity, we mean there's a lot of difference. And it's the same thing with your stock portfolio. You want a lot of different stocks, a lot of different types of stocks, big stocks, little stocks, big companies, defensive companies, in order to shield yourself from the general ups and downs of the market. Because some of our stocks will gain value on a given day, some will lose value on a given day, but because we have lots of different stocks in our portfolio, we're not going to get hurt too badly if one company has a bad day or not. Another way of viewing it is to say never put all of your eggs in one basket. So some other ways that we can categorize our stock is based on size. Market capitalization is a term that we use that looks at how much stock is out there. What is the value of all of the shares of stock that people own? And the larger the capitalization, the bigger the company typically. And the way to measure market cap is to take the number of shares times the current stock price, and that will tell you what category the company fits in. So if you have a 2 million shares outstanding at $10 a share, you would have a $20 million market cap. And while you don't have to memorize these different categories, it's important to recognize there are many, many different categories in which companies can fit in. The most common categories that people talk about are large cap, mid cap, and small cap. But there are companies that are as small as 50 million or less, and there are some that have $100 billion or more in outstanding shares. You want a little bit of each, again, to protect yourself and to have that properly diversified portfolio. Another category that we could use to describe stock would be growth. Growth companies tend to expand at an above average rate. They're usually small, aggressive companies trying to gain market share and become the big, large, successful companies that others have become over time. They are focused on getting bigger, and that is what they are primarily going to be putting their money toward. So growth companies tend not to offer dividends. You could choose a value company. Value companies are ones that tend to be undervalued for some reason. That their price per share is low relative to the earnings that the company is generating. So they can be very profitable, but their stock price is low. That would be a value stock for you to purchase, mostly because you're getting a good deal for your money. Another option could be an income stock. Income stocks tend to be ones that cause your portfolio to grow over time due to the receiving dividends. So income companies pay out dividends on a pretty consistent basis, and they tend to be pretty generous dividends. And so you're going to want some of your stock portfolio to have that income element in order to help your portfolio grow over time without you having to actually put any of your own money into it. And then finally, cyclical versus counter-cyclical. Some companies do well when the economy is good, and some companies do well when the economy is bad. And so you want a mix of both of those, because the economy is going to go up, it's going to go down, and you want to protect yourself from the ups and downs by having a little bit of both types of companies in your portfolio. You could also categorize your stock based on what the company does, or by sector. So we're looking at industries, and we don't want every company in the same industry, because if the industry goes bad, you lose all your money. So you want companies that are in a variety of different industries. Maybe it's in the healthcare industry, and in transportation, and in energy and oil and gas exploration, and maybe some insurance companies. You want a variety of industries in order to, again, protect yourself from the downs of the economy, but then also give you a chance to take advantage of the ups that happen throughout our economy. Because every sector is affected differently, you have a greater chance of taking advantage of positive changes while protecting yourself from the negative ones. One final thing we want to mention about the stock market is that there are terms to describe how healthy the stock market is. We use two different animals to describe the health of the market. One is the bull, and the other is the bear. When we talk about bear markets, we're talking about markets that tend to be slowing down, because bears tend to slow down in the wintertime. When bears go to sleep, they're safe, they are not doing very much, and when the bear market occurs, that means that stocks are sort of going to sleep or hibernating. They're not doing very much. The market itself is beginning to shrink and lose value. Okay, so when people believe that the economy is going to do poorly and begin to slumber a little bit, we say that we have a bear market. Not all stocks will lose value, but many will, and that's just the natural part of investing. The alternative is a bull market, and bulls tend to charge forward and be aggressive. And so when we have an economy that's healthy, people who are investors tend to purchase stocks, and they begin to charge ahead, and they begin to pay more for stock because they believe the economy is going to do well. They think that their stock prices will continue to rise, and they want to be able to buy it now while it's still relatively cheap. And so bull markets are for markets that are gaining value. But again, not all stocks will gain value. That's why you have a diversified portfolio, so that you get advantages when stocks go up and protect yourself from when they go down. And so you'll see those two terms, bull and bear, and you do need to make sure that you're clear on what type of market is occurring when you see those animals. We'll talk more about different types of investments other than stocks, and why you would want to even be involved in the stock market in a future video.